Hello, and welcome to the Banker's Tech Talk video series looking at all things fintech. The series has been going for 5 years now, and you can view all the previous episodes on thebanker.com/techtalks. I'm Joy Macknight, managing editor of The Banker, and I'm joined this week by Luke Sully, who's CEO of Custody Digital Group, which is a digital assets custodian. Luke, thanks so much for joining me today.
Pleasure.
So can you just tell me a little bit about why digital assets need custodians?
So custody is defined as the safeguarding and administering of assets. Particularly for institutions, this can be very important. Within the context of high volumes of assets, or particular cases where strategically a buy and hold strategy is prevalent. There's also regulatory requirements in some cases for certain institutions to use one or multiple custodians to hold assets on their behalf. In the crypto context, I would say that its adoption has still been quite slow. And out of the $250 billion market cap that is currently cryptocurrencies, we estimate that something like less than 10% of those assets are currently being custodied. Companies or startups in the fintech space have only been a going concern for about 5 years. So it's still very, very early days. But the reality is that custody in this context remains, frankly, a deeply misunderstood and an undervalued part of the infrastructure stack. That's partly due to having poor use cases for custody in the cryptocurrency context. And partly because the existing role of a custodian in the traditional context doesn't neatly fit into the context of cryptocurrencies.
So how does Custody Digital Group, how do you really address these issues?
If you look at the two main technical components of custody in digital asset context, they can be boiled down to essentially the storage of the asset and then the governance and the control framework to manage the access to those assets and manage the assets to conduct sort of corporate actions on behalf of the client. The reality is the mechanics of storing the asset was the primary focus for the first wave of custodians that came into effect in 2015. But the reality is that storing keys is not a technical problem that really ever needed solving. So there was the emphasis on essentially the wrong part of custody was taking place, and that skewered the business models and the value add and how they interacted with the ecosystem at large. And there's really, the reality is, again, in an institutional context, there's not a lot of value in cryptocurrency tokens sort of sitting there with a custodian doing nothing. And in fact, we talk about custodial flows rather than stopping the asset in storage to do nothing. So when we came in, we looked at the problem, and we actually understood a different problem in custody. So there's actually a significant amount of operational risk when you have multiple assets, multiple parties, a lot of layered financial controls that are all required to transact with digital financial tools and the networks between businesses and individuals and different protocols. And so in our view, the emerging objective of a custodian is to help manage that risk whilst preserving the rights and privacies of our clients. Or to put it more simply, it's much more difficult to manage decision makers, co-signers, asset types, legal responsibilities in this new world than it is to essentially provide storage equipment for digital assets. And so that's really what we're trying to bring to the table. And we hope that by doing that, that will encourage institutions to feel more comfortable that there are the appropriate frameworks in place and platforms in place for them to execute a variety of digital asset strategies as it gets more complicated and more complex.
Well, thank you so much for your insights, Luke.
Thank you.